June 2024, Paper 2R. Paper 2, Financial Statements. Tang, a sole trader, provided the following balances at 31st December 2023. So we have a set of information given, such as business rate, carriage inwards, carriage outwards, fixtures and fittings provision for depreciation, general expense, insurance, irrecoverable debts, motor expense, motor vehicle, and we have motor vehicle provision for depreciation, opening inventory, premises at cost, purchasers, return outwards, and revenue. And we have a set of additional information, closing inventory of 9345 on 31st December 2023, business rates 570 were owing, and insurance 600 was paid in advance. During the year, Tang took goods costing 3,290 for his personal use. The purchases of new motor vehicle 15,000 had been included in the motor expense account. Depreciation on non-current assets is to be provided as follows: fixtures and fittings 10% per annum using straight line method, and for motor vehicle 25% per annum using reducing balance method. A full year's depreciation is charged on assets held at the end. You had been asked to prepare an income statement for the year ended 31st December 2023. And then you have a theory question for 5 marks. Right. Now, you should first remember the important components of an income statement. So you start with net sales. So you have revenue, take away sales returns, or you call it return inwards. The second component, which you less cost of sales. So under cost of sales, opening inventory, purchases, any purchases returns you deduct, any goods drawings deduct, carriage inwards add, and then closing inventory which you deduct. Third component, add any other income. Fourth component, less all the expenses. So these are the important components of an income statement. Right? Now, having this in mind, now let's prepare the income statement, and prior to that, it's important that all the adjustments are completed. Right. So let's finish the additional information. Closing inventory. So let me keep some components ready. So the first component is net sales. Then you have cost of sales. Then you have other income, and then expenses. Right. So I'll keep the cost of sales in yellow. As you can see here, closing inventory goes under the section of cost of sales, which you deducted. On 31st December 2023, business rates 570 were owing. So any amount which is owing at the end of the year gets added, and any expenses which are prepaid or paid in advance deducted. So let's go to expenses. And under expenses, we have business rates. Let's find out where's business rates. This business rates. And then there's insurance. Business rates, it's 570 owing. So 1430 plus 570. And then insurance 600 prepaid, paid in advance. Therefore, here it should be 3000, 3600, take away 600, and the other one 1430, take away, plus 570, which should give 2000. So those will appear under expenses. During the year, TAN took goods costing 3,290. Hope you can remember the format under cost of sales, and any goods drawings will go under the cost of sales section. This, right? So this will appear under the section of cost of sales, and this amount will be deducted. The purchases of a new motor vehicle 15,000 had been included in the motor expense account. So you add this to the motor vehicle account and deduct it from the motor expense account. So this impacts the expense, and this one impacts the non-current assets such as motor vehicle. So let's adjust that. So this 15,000 to deduct from the motor expense account. So that is 22,890, take away 15,000, which is 7,890. And then add this 15,000 to the motor vehicle account. Okay. 35,000 plus 15,000. Now it's 50,000. This will be adjusted under expenses. Now let's calculate depreciation, fixtures and fittings. It says 10% per annum. Straight line method, so we have to calculate depreciation for fixtures and fittings. So let's move to fixtures and fittings cost, and it's 10% straight line method. Let's calculate the depreciation. So that's 10,000 into 10% should give you 1,000. Now this should go under expenses as fixtures and fittings provision for depreciation for the current year. Motor vehicle 25% using reducing line method. Go to motor vehicle. Now you have 50,000, so 50,000, and then you take away the previous year's depreciation minus 5,000. Therefore 45,000 into 25%. So 45,000 into 25% should give 11,250. Now this will be the motor vehicle provision for depreciation for the current year under expense. We are done with that adjustment. Right. Now let's see what's left over. So I keep the net sales in red and other income in orange. So let's figure out the revenue. This goes under net revenue. Carriage inwards under cost of sales, you add. Carriage outwards, you go under expense. General expense goes under expense. Irrecoverable debt is an expense. Opening inventory, cost of sales. Premises at cost does not reflect in the income statement. purchasers cost of sales add, return outwards cost of sales deduct. Now let's post the entries to the income statement. The first element in the income statement is net sales section. We have only revenue here, therefore let's enter the revenue figure. Now cost of sales. So we have carriage inwards 800, opening inventory 8,700, purchases 89,000, return outwards 4256, closing inventory 9345, goods drawings 3290. Now let's post this under the cost of sales section. So we had opening inventory 8,700, purchases 89,000, return outwards deduct 4256, goods drawings we deduct 3290, carriage inwards 800, deduct closing inventory. Now let's find the cost of sales. 89,000, take away 4,256 plus 800, take away 3,290 and take away 9,345. And then we find out the cost of sales. Let's redo the calculation. Sorry for that. 8,700 plus 89,000, take away 4,256 plus 800, take away 3,290, take away 9,345, which should be 81,609. Now from the revenue, which is 150,000, take away the cost of sales 81,609, which should be 68,391. Right. There aren't any other income in this question. So we had figured out the cost of sales, and followed by that we have gross profit. Now let's list all increase in expense. Option 2. By purchasing an accounting software, the business will incur the expense of purchasing the package, and that is one-time investment. So what happens as an outcome, which will increase capital expenditure for that year only? So what's the advice? I would advise Tang to purchase the accounting software as it will make his business more efficient. It can be more quicker, and there is an asset which you had purchased, and the software can be reused throughout the year. Now let's move to the second part of this paper, question 2. Bob, a sole trader, provided the following information as at 29th February 2024. Allowance for doubtful debts, bank loan, cash at bank, cash in hand, drawings, equity, fixtures and fittings, inventory, motor vehicle carrying value, other payables, other receivables, profit for the year, trade payables and trade receivables. You had been asked to prepare a statement of financial position for Bob at 29th Feb 2024. Remember the accounting equation. What do we have? We have assets equals capital plus liabilities. There are two types of assets. You have non-current asset, that should be number 1. Number 2 is your current assets. So that is the first section of your statement of financial position. Under capital or equity, you have the opening equity. As per this question, you have opening equity. The second, the profit for the year. The third, any drawings that will be deducted. Under liabilities, the first one is non-current liability and the second one is current liability. Right? So let's keep the non-current assets in this color, current assets in orange. So equity, then you have profit for the year, then drawings, non-current liability, and current liability. Now let's classify these under each section. You do not have any non-current liability in this question. You can ignore it. Now let's look for the current liabilities. As you see here, you can figure out other payables is a current liability, trade payable is a current liability. Let's find out the non-current assets, fixtures and fittings carrying value, motor vehicle carrying value. Current assets, cash at bank. I'm sorry about non-current liability, there is a non-current liability, sorry for that. Then cash in hand for current assets, inventory is a current asset, other receivable is a current asset, trade receivables current assets. Then the equity at the start of the year and the profit for the year, any goods drawings, and non-current liability bank loan. And this allowance for doubtful debt should be adjusted under non-current asset. This needs to be deducted. Drawings also will be deducted. Now let's post entries to the statement of financial position. Let's complete the statement of financial position for 29th Feb 2024. The first section, the non-current asset, followed by the current asset, total to find out the total assets. Then the equity and liabilities, equity, profit for the year, less drawings, add non-current liabilities, add current liabilities. Now let's finish this one at a time. Non-current assets. As you can see here, you have two types of non-current assets: fixtures and fittings carrying value 11,900, motor vehicle carrying value 15,400. Now let's list them under the non-current assets and then write the carrying value figures. Now let's add up the totals of these two. So you have 11,900 plus 15,400, which is 27,300. Now let's complete the current asset section. Going back here, you should remember that the current asset should be written based on the liquidity basis. So you have inventory 8531, that should be the first. Followed by that, trade receivables, which is this, under current asset 8490. And we are writing this in the first column, the reason being that there's provision for doubtful debts worth 346. Let's deduct that figure and then find out the difference between these two, which is 8490 take away 346, which should be 8144. And let's see what else is left. We have other receivables 600, followed by cash at bank 2198, cash in hand 289. Now let's total this up. So it's 8531 plus 8144 plus 600 plus 2198 plus 289, which should give 19762. Now let's add up the total non-current assets and current assets, which is 27,300 plus 19,762, which should be 47,062. Now let's complete the equity section. You have equity worth 30,000, profit for the year 8,083, this should be the second one, and the drawings worth 5552. Now let's enter these figures. Equity 30,000, profit for the year 8,083, drawings you deduct 5552. $30,000 plus 8,083, take away 5,552, should give 531, sorry. Now the next is to list the non-current liabilities. There's a bank loan of 10,000. Let's enter the 10,000 bank loan. Under current liabilities, we have other payables 211, and then trade payables 4,320. Let's list them. Now let's add these two in order to get the total current liabilities. Now add the equity section, non-current liabilities and the current liabilities. $32,531 plus 10,000 plus 4,531 should give 47,062. As you see here, the total assets of 47,062 should be equal to the total equity and liabilities, which is 47,062. Calculate Bob's current or working ratio and liquid asset ratio. Stating the formula used, answers should be given to 2 decimal places. So how do we calculate current ratio, current assets over current liabilities? So let's figure out the total current assets that we have. So the total current assets we have 19,762. Divide this by the total current liabilities. We have 4,531. So 19,762 divided by 4,531 should be 4.36. Remember to write it at least for 2 decimals. So 4.36 is to 1. Now let's calculate liquid or asset test ratio. Current assets take away closing inventory over current liabilities. So we already have the total of current assets, which is 19,762, and we have the current liabilities, which is 4,531. Let's find the closing inventory in the question, and we have closing inventory which is worth 8,531. Therefore 19,762 take away 8,531. I'll figure out the answer. Divide that by 4,531, the total current liabilities. So it should be 2.478. So if you round up to 2 decimals, it's 2.48. Next question. Evaluate both ratios and state whether Bob should be satisfied with these figures. Remember, for current ratio, the industry standard should be 2:1, and for liquid ratio, it should be 1:1. This should be the industry standard. So it shouldn't be below this, it shouldn't be higher than this. As you can see here, we can see that the working capital ratio is 4.36:1, which is much higher than the industry standard, as you can see here. And for liquid ratio, it should be 1:1, but it is 2.48. Again, it's higher than the industry standard. Now, having this basics in mind, let's see how we can evaluate both ratios. The current ratio indicates that the business is able to meet its short-term debts because it's higher than the industry standard. However, as the figure exceeds the benchmark of 2:1, this indicates that there is poor management of working capital. Too much of current assets are tied up within the business, which is underutilized. So there is a however as well. For liquid ratio, the liquid ratio indicates that the business is able to meet its short-term debts without having to sell its inventory because we take away the inventory over here. However, the figure exceeds the benchmark of 1:1, which may indicate an excessive amount of resources tied up in either trade receivables or in the business bank account. Now we come to the conclusion part. Although both ratios indicate a positive liquidity position, Bob should not be satisfied as the business needs to take action to return to the benchmark for each ratio. So you can see how each mark is gained for this 5 marker. Now we had come to the end of this paper. So the first question was based on preparing an income statement with additional information given there. We had found till profit for the year. Then we had few theory questions on, option 1 and option 2, employing a part-time bookkeeper or to purchase an accounting software package. And we had given why option 1, why option 2, and then advice what should be the best because it's a 5 mark. Followed by question 2 was a set of information with assets and liabilities, equity, and you were expected to prepare a statement of financial position. This is a super easy question if you know the format of a statement of financial position. Followed by that, part B is to calculate the current and liquid ratio. We'd calculated, and the second part of part B is to evaluate both ratios, whether Bob should be satisfied with these figures, and we had derived with a final answer for the 5 marker.